Assalamu alaikum. So this is the series of first video lecture in the series of video lectures for chapter number 11, which is asset-backed sector of the bond market. In this chapter, we will go through various different, you can say, sections of the asset-backed securities and try to understand what they are. So what are the asset-backed securities? They are basically an alternative to issuing a bond. So instead of issuing a bond, a corporation can issue securities which are backed by some loan or receivables or some asset, we can say. The thing is that asset should be some income or cash flow generating asset. So these are the debt instruments that have as their collateral have a loan and receivables are referred to as asset-backed securities. The largest sector of asset-backed securities market in the United States are securities backed by credit receivables, auto loans, home equity loans, manufactured housing loans, student loans, and small business administration loans. We will discuss each of these in this chapter. Since home equity loans and manufactured housing loans are backed by real estate property, the securities backed by them are referred to as real estate-backed asset-backed securities. The securitization process and features of ABS. So we will start from the ABS. The issuance of an asset-backed security is more complicated than issuance of a corporate bond. Why? Let's see why. The basic securitization transaction. Let's take example and then continue that example to understand the ABS and the securitization process that involves issuance of the ABS. Let's assume that there is a company called Quality Home Theater Incorporation, which manufactures high-end equipment for home theaters. The cost of one of QHT's home theater ranges from $20,000 to $200,000. Some of its sales are cash, but its bulk of sales on basis of installment contracts, and those installment contracts are a kind of loan to the buyer of the home theater, in turn, who agrees to pay back over a specified period of time. For simplicity, we will assume that the loans are typically for 4 years, and the collateral for the loan is the home theater purchased by the owner. The loan is obviously, because it's a loan, will specify some kind of interest that the buyer must pay. The credit department of QHT decides whether to extend loan to customer or not based on the credit standards. Because QHT is extending the loan, it is referred to as the originator of the loan. It may have a department responsible for servicing the loan. Let's assume that it has 100 million installment sale contracts. This amount is shown on QHT's balance sheet as an asset. Also assume that QHT want to raise 100 million, right? So what it can effectively do is it can remove these 100 million assets from the balance sheet and raise 100 million of money using asset-backed security kind of securitization. The first step will be establishing of a special purpose vehicle. Let's suppose it's a home asset trust established by QHT in order to raise those 100 million. What then QHT will do is it will sell 100 million of loans to HAT, and HAT will provide 100 million in cash, right? But now the question is, where does HAT get 100 million? It obtains those 100 million by selling securities that are backed by these 100 million loans, right? So what HAT will do is will convert these 100 million into asset-backed securities and sell those securities to the investor and raise 100 million and pay those 100 million to QHT in return of the loan, right? So the structure will typically look like this. So there is a customer buy a home theater equipment, and from the quality home theater, and the quality home theater make a loan to the customer. Then the quality home theater sell customer loans to the home asset trust, and home asset trust pay cash for the loan. In our case, which is 100 million. What home asset trust do, which is an SPV, what they do is they sell securities to the investor, which in turn provide them cash, right? So this is how a typical structure works. The payments that are received from the collateral, the customer, by the QHT, are distributed to pay servicing fees, other administrative fees, and principal and interest to the security holders, right? So the legal documents in a securitization will set for the considerable detail the priority and amount of payments to be made to the servicer, administrators, and the security holders of each class. The priority and amount is commonly referred to as the waterfall. We come to this, but it is referred to a waterfall because as the water comes, it should be redistributed towards the various different usages. So, who are the parties to a securitization? We have already discussed. We have discussed that one of the party in the securitization is the seller of the collateral. In our case, which is the originator, which we specify as Quality Home Theaters Incorporation. Then we have the special worker purpose vehicle, which is here the home asset view. Then we have the servicer. In our case, the servicer is the same as the seller of the collateral. There are other parties involved in securitization, which are attorney, independent accountant, trustees, underwriters, rating agencies, and guarantors. And all of them have a different role. Because there is a good length of legal documentation involved, you can say there is a purchase agreement between QHT and SAT. So they all need the attorneys, right, to deal with these things. Then there is also the structure waterfall agreement, the servicing agreement, and all other kind of the things. So we are not going into these details, but there are various different kind of parties involved. The bonds issue. Let's talk about. So until now we were talking about the one side of the structure, which is how the loans are converted into assets. But now let's talk about what happens to those securities. What kind of securities are issued from this asset-based structure? A simple transaction can involve the sale of just one bond class with a par value of 100 million in our illustration. We will call this bond class A. Support here issues 100,000 certificates for bond class A with a par value of 1,000 per certificate. Then each certificate holder would be entitled to 1 by 100,000 of the payment from the collateral after payment of the fees and expenses. Each payment made by the borrower consists of principal and the interest. Right? Structure can be more complicated like this. It can have bond classes A1, A2, A3, and A4. And these bond classes can then have the priorities as well, as we have discussed in the mortgage-backed securities examples, right? A simple structure would be a sequential pay one like this, as explained in the previous chapter, that A2 will not be paid until and unless A1 is fully repaid, and then A3 A3 will not be paid until A2 and A1 both are fully repaid, and so on. However, the principal is repaid as follows. All principal received from the collateral is paid first. This is the thing I just explained to you. So there are a structure where there is more than one bond class, and bond classes differ as to how they will share the losses resulting from defaults and borrowers. In such a structure, the bond classes are classified as senior and subordinate bond classes. The structure is called senior subordinate structures, just like this one. Losses are realized by subordinate bond class before there are any losses realized by the senior class. For example, here 90 and 10. In this structure, as long as there are no defaults by the borrower greater than 10 million, then bond class A will be repaid fully. It's 90 million, right? The purpose of this structure is to redistribute the credit risk, right? Just like the purpose here is to redistribute the prepayment risk. There can be a multiple subordinate bonds in a structure. So instead of just B, we can have a bond class B and C. So here the losses will be first bared by the bond class C. And if there are some losses above 3 million, then they will be bared by B, and A will not bear any losses until and unless the losses are above 10 million. So this C will be referred to as first loss piece, because it have to absorb the losses first. Finally, often logic, there can be a structure just like this, in which there are multiple senior bonds, and then we have a multiple subordinate bonds. So these multiple senior bonds are A1, A2, A3, and A4, and then this. In this structure, there is both prepayment tranching and the credit tranching, right? So A1 will be paid first, and repayment will only go to A2 when A1 is fully paid. The same way A3 will be only paid when A2 and A1 are paid, and so on. But if there are losses, the losses will be above, if there are defaults, and the defaults will be bared by this C class bond, and so on, just like we have discussed it here, right? So this is all about the bonds which are issued out of asset-backed security. Let's talk about something about the classification of collateral and transaction structure. In general, the collateral can be classified either amortizing or non-amortizing assets. So there can be underlying loans or receivables who are amortized, means they are fully paid at maturity, and there can be which require a lump sum payment at maturity, right? So the in case of amortized bonds, the schedule of repayments of the principal is called the amortization table. The standard residential mortgage loans fall in this category. Auto loans and certain types of home loans are also amortizing assets. Any excess payment over the scheduled principal payment is called the prepayment, and that prepayment can be paid off the entire balance or partial payment, called the curtailment, as we already discussed. In contrast to amortized assets, non-amortized assets require only a minimum periodic payments with schedule of principal payment. If that payment is less than the interest on the outstanding loan balance, the shortfall is added to the outstanding loan balance. If the periodic payment is greater than the interest on the outstanding balance, then that reduces the outstanding balance. Since there is no schedule of principal payments, so there is no concept of a prepayment. So the prepayment is dealt with as we discussed here. It reduces your outstanding loan balance. Credit card receivable is a good example of non-amortized assets. The type of collateral has whether it's amortized or non-amortized has an impact on a structure of transaction. Typically, when amortizing assets are securitized, there is no change in the composition of collateral over the life of securities, except for loans that have been removed due to defaults or full principal payments, full principal repayments. In contrast, ABS transaction backed by non-amortized assets, the composition of collateral changes during the life of the ABS security. The funds available to pay the security holders or principal payments and interest. The interest is distributed to the security holders. However, principal payments can be either paid to the security holders or reinvested by purchasing additional loans. Let's consider what will happen to the principal repayment depends on the time since the transaction was originated. We will discuss this in detail when we discuss different categories of asset-backed securities like credit card loans. But typically, for a certain period, it is called a lockout period when all the principal payments coming from the collateral is reinvested, and after that lockout period, the principal payments are not reinvested and they are paid back to the security holders, and this is called the principal amortization period. You can notice the difference between the amortized assets and here the collateral backed by non-amortized assets changes over time, right? A structure in which principal payments are reinvested in new loans is called revolving structure. Okay, let's talk about the collateral cash flow. For amortizing assets, the projection of cash flow require projecting the prepayments, just like the projection of prepayments we talk about for mortgage-backed securities. One factor that may affect prepayments is the prevailing level of interest rates relative to the interest rates on the loan. If projecting prepayments, in projecting prepayments, it is critical to determine the extent to which borrowers take advantage of the decline in interest rate below the loan rate in order to refinance the loan. As with non-agency-based mortgage securities described in the previous chapter, modeling defaults for the collateral is critical in estimating cash flows for the asset-backed security. Proceeds that are recovered in the event of default of the loan period to the scheduled principal repayment date of an amortization as it represents a prepayment. Projecting prepayments for amortization assets require assumption about the default rate and the recovery rate. For non-amortized assets, while the concept of prepayment does not exist, the projection of default is still necessary in order to project how much will be recovered and when. The analysis of prepayments can be performed on a pool level or a loan level. So a pool level analysis assumed that all loans comprising in the collateral are identical, while on loan level you have to assume that no, they are different. For amortized assets, the amortization schedule is based on the gross weighted average coupon and the weighted average maturity for that single period. As we have already discussed these two concepts in our previous chapter, so we are not repeating them. Pool level analysis is appropriate for where the underlying loans, as I guess, are homogeneous, and otherwise you have to do loan level analysis. Okay, so now let's talk about the credit enhancement. Credit enhancements. So all asset-backed securities are credit enhanced. That means that support is provided for one or more of the bondholders in the structure. What we mean by credit enhancement is that increasing the credit worthiness of the underlying collateral. And in turn, the increasing the credit worthiness of the securities issued. So credit enhancement levels are determined relative to a specific rating desired by the issuer for a security. Specifically, an investor in a triple A rated security expects to have a minimal uh, chances of losing any principal due to defaults. For example, a rating agency may require credit enhancement equal to 4 times expected losses to obtain a triple A rating, or a 3 times expected losses to obtain a double A rating. There are two types of credit enhancements. There can be external and there can be internal credit enhancement. In external credit enhancement, there are two principal parties. So in an ABS, there are two principal parties, the issuer and the security holder. If an other entity is introduced into the structure to guarantee any payments to the security holders, that entity is referred to as third party, and that entity will serve as an external credit enhancement. The most common third party is this in securitization is a monoline insurance company. Uh, it is an insurance company whose business is restricted to providing guarantees for financial products such as municipal securities and asset-backed securities. So what insurance company will do that you have to pay them certain premium periodically, and they will ensure that they will pay in case of defaults for any underlying loans. When securitization has external credit enhancement that is provided by monoline insurer, the monoline insurer agrees to make timely payments for interest and principal up to a specified amount should the issuer fail to make payment. Just like said, unlike municipal bond insurance, which is guarantees the entire principal amount, right? So two less common forms of credit enhancement. So this is the most common using a monoline insurer. The two less common forms of external credit enhancement are a letter of credit from a bank and a guarantee by the seller of the assets. In our case, the QHT, right? The reason why these two forms of credit enhancement are less common is because the one of the approach used by credit rating agencies in deciding credit rating is the weak link approach. So what is the weak link approach? It is when rating proposed structure, the credit quality of security is only as good as the weakest link in its credit enhancement, regardless of the quality. So due to the lack of good quality issuers and good quality banks, these two approaches are less common. Then there is internal credit enhancement. It can take either the form of reserve fund or our collateralization or senior subordinate structure, as we already discussed. Reserve funds can be in form of cash reserve funds or excess spread accounts. Cash reserve funds are straight deposits of cash generated from issuance proceeds. In this case, part of the underwriting profits from the deal are deposited into a fund which typically invests in money market instrument. Cash reserve funds are typically used in conjunction with external credit enhancement. Excess spread accounts involve allocation of excess spread or cash into a separate reserve account after paying out the net coupon, servicing fee, and other expenses on a monthly basis. The excess spread is designed future of the structure. For example, suppose that gross weighted coupon is 8%, servicing fee is 0.25, and the net weighted average coupon paid is 7.25. The remaining 0.5% will be deposited into an excess reserve account. So these are two type of categories under reserve funds. Then you have our collateralization. In our collateralization, the value of the collateral usually exceeds the amount of par value outstanding. So you put more collateral as compared to the you issue the securities. So for example, in our case, 100 million par value securities can be over collateralized by 5 million by putting a collateral value of 105. So if our time, the amount of collateral changes due to defaults in amortization or prepayments. Then we have senior subordinate structure, as we have already explained. Uh, More specifically, the senior subordinate rate is a form of internal credit enhancement because of subordinate bond classes provide credit support to the senior bond classes in order to achieve higher credit rating. Let's talk a little bit about the final topic in this video, which is the call provision. Asset-backed securities typically have call provisions. The motivation is twofold. As with other bonds, the issuer will want to take advantage of decline in interest rates, right? So what they do is they issue the callable asset-backed securities. In addition, to reduce administrative fees, the trustee may want to call in the issue because the par value of the bond class is small and is more effective to pay off the one or more bond classes. In the case of asset-backed securities, it is not simply the passage of time whereby the trustee is permitted to exercise any call option. There are trigger events for exercising call option as well, right? So for the asset-backed securities, there are trigger events. A call on or after a specified date operates just like a standard call provision for corporate, federal agency, and other bonds we have discussed. In an auction call, at a certain date, a call will be exercised if an auction results in the outstanding collateral being sold at a price greater than its par value. The premium over the par value received from the auction collateral is retained by the trustee and is eventually distributed to the seller of the assets. Provisions that allow the trustee to call an issue or a tranche based on the par value outstanding are referred to as optional cleanup call provision. In percent of collateral call, so it's another type of call option. The outstanding bonds can be called at par value if the outstanding collateral's balance falls below a predetermined percent of the original collateral's balance. This is the most common time of cleanup call provision for amortizing assets, and the predetermined level is typically 10%. So, for example, suppose the value of the collateral, as we discussed in our example, is 100 million. If there is a percent of collateral call provision with a trigger of 10%, then the trustee can call the entire issue if the value of the call is 10 million or less. There is a call option that combines two triggers based on the amount outstanding and the date. That's all I think about this background or the overview video of the asset-backed securities. From next video on, we will discuss in detail different types of asset-backed securities.